Dwight
It's,
Millard on Q Home Loans. How are you, my friend?
I'm doing fantastic, John. I'm so happy you're the staple one all the time, but it is your show. But yeah, Corey and I do find the ways to get out, don't we? It's
I
just,
know, I
it's,
know, I
it's,
know.
it's just crazy. Like, as you know,
It
there's
is
just so
so
many
busy for
obligations
everybody.
pulling you everywhere. You get the same thing,
Uh-huh.
but
Uh-huh.
yeah, so
Yep.
that's
But
a pleasure to be with you. Yeah.
likewise, my friend. Likewise, my friend. Great to be with you as always. Now it's interesting times that we have right now. Dwight, what kind of day was it today on the Dow Jones Industrial Average? Let's start with that. Let's just get that news going.
I'm gonna guess, John, it's another record-setting day. I don't know if it's a trifecta. I just been crazy today, but I know it's another record-setting. I saw the morning. It's kind of crazy. Good for
Yeah,
you. Good
yeah,
for us,
definitely.
right?
Good
Good
for
for all of
us.
us, right?
Amen to that one.
Yeah.
Amen to that one. Yes, it was a record-setting day on the Dow, and we, of course, are going to tell you all about that and what it all means. A little bit sloppy on the Dow, or excuse me, on the Nasdaq and on the S&P side of things. But again, we're going to give you the overview of what's happening. But let me tell you what our topic's going to be. Speaking of Mr. Millard, Mr. Edge is tied up in an appointment. He's not like he has the day off. He's tied up in an appointment right now. So here's what we're going to be doing. I don't think, Dwight, correct me if I'm wrong. Your memory seems to be better than mine. But I don't think in the 20 years plus that you've been with me that we've ever done a show on this before. And so I have been looking forward to this all day long. What we're going to be talking about is we're going to expose what we call the mortgage myths that could be costing you as a home buyer thousands and thousands of dollars. Things like, do you really need a 20% down payment? Is a 15-year mortgage always better than a 30-year mortgage? Should you wait for interest rates to fall before buying? So, Dwight, these are just a few of the myths. I mean, you've put together, let me count them here. We got at least 7 of them, and we'll see if we get through all those, or maybe we'll throw a few more in because your industry, like mine, is fraught with myths, right? People have misconceptions in their mind of how this works, how that works, that type of thing. And many times it gives them, analysis paralysis. It stops them from doing the things that maybe they should be doing, as far as getting into a home or refinancing or buying that first rental. Because again, they have these preconceived notions in their mind that, oh, wait a minute, interest rates are not where they used to be. And oh, wait a minute on this and wait a minute on that. And you know what? That, of course, can be absolutely financially devastating, right? You miss out on things. And so that is the goal of today's show that you have put together, which is creating these or demystifying these myths so that no one makes a wrong decision or hesitates to make a decision because they don't have the information, right?
Yeah.
Never can happen on the show.
And John, it comes back to your world as well. I mean, everybody has a specific need, right? Now we don't all get the same haircut, right?
Right, right.
So it's not all going to be the same when you go in. I mean, there are going to be some clients that a 15, absolutely. There's some clients a reverse mortgage, right? There's some clients, it really depends on the situation. But I think when people research or they hear things, what they're hearing is the generalization, right? The averages, right? Oh, this person put 20% down and this,
So I need to do that. Yeah.
Yeah. So we'll get, my favorite loan program we've talked about, and I can get into the reasons why is a 5% down conventional.
know
I
it.
mean, if you have high credit scores, I'll tell you the reasons why. But it's a interesting topic. You get this, you get this question almost every day, right? What is my best? What do I need to do? And I'm hoping that the 40 years I've been doing this helps eliminate some of that confusion for people,
exactly.
right? Because I mean, I always say the more vanilla product you can get, the better off you'll typically be, right? If you've got to add sprinkles and all this other stuff attached to it, it probably is not going to be the right thing for you. I mean, if you have a nice hefty down payment, for, either you've saved or you have from your parents, got a gift or something, a first-time homebuyer program probably typically won't be the one you want to go with. Right. So, I mean, those are the things that you want to people need to understand because it just doesn't make a lot of sense. You're kind of going, it's like a veteran. It's like a veteran putting money down, putting 10% down, kind of defeated the purpose of and again, there might be a reason why, John, so we can, you can argue that, but historically, traditionally speaking, you're defeating the purpose by putting any money down on a VA loan.
Yes.
Unless you're trying to buy out of the funding fee or something. But I mean, for the most part, that kind of goes against why are you if you're going to put 10% down, let's do a conventional, keep your VA.
So I've got a quick question for you. Then we'll get to the stock market recap and then all about you. The question is this. I don't think I've ever asked you this. Are people shocked, Dwight, when they come into your office or virtual, nowadays, and you go through all the preliminary questions, et cetera, and then you come back with your recommendation, which is, let's say, a 5% down payment. Are they shocked when they're like, wait a minute here, I was coming into this deal expecting to put 20% down because that's what I've heard, right? Again, one of the biggest myths that are out there. What's their reaction when you tell them they only got to do 5%?
They love it, John, and
I
they
bet.
absolutely love it.
Like, oh my God, I got all this
Yeah,
money
I
left
got to
over.
keep and I always say, and I think you're a big advocate of this as well. Cash is king. The more you can,
Yes.
if it's not making any difference in your payment, why are
Right.
you tying up the cash? If you can do something, I mean, you can go a long ways with it, just, with you. And
Absolutely.
so
Absolutely.
but those are the good surprises because I go, man, that's
Yeah.
amazing. I didn't realize I could do that. And so there are some really good, tools out there that people can use, but that's a great one, and then
Yeah.
a lot of times their payments, they like it when their payments cheaper, because they
Absolutely.
went on these
Absolutely.
calculators online and it overcalculated everything, and so that's always another pleasant surprise for them. So
Absolutely. No, that's great, man. That's great. And again, I'm so excited to go over this topic with you. So let me get my side of the business out of the way for you, and then turn things over to you. So let's get this going. Well, as we said just a few moments ago, it was a record-setting day for the Dow, but a little bit sloppy on the Nasdaq and on the S&P side of things today. So here's how we finished up: 329 gain on the Dow to a record close of 51,000. You know what? I'm going to round it up. I'm going to round it up, and I deserve what to do it. I'll tell you why. The Dow closed at 51,999.67. Now, you're a numbers guy. I think we
yeah,
deserve to round it up above
52.
50. Yeah, right to 52. Exactly. First time ever in history, obviously. Just miraculous. And again, I have to remind myself that when I got started in this business, 35 plus years ago, we're at the 2400 on the Dow. And here we are, 52,000. Just absolutely amazing. NASDAQ, though, had a little problem there, and I'll explain why. NASDAQ finished down 304 points, 1.15%, closing at 26,376. The S&P 500 for the day, down 43 points or 0.57%. So nothing too major there. What was the problem? The problem was the chip sector, information technology sector, down about 2.3%, finished with the widest loss by a considerable margin. And this is why. We had a 3.4% gain yesterday, right? So this is that cyclical profit taking that we see in the semiconductors. They in particular were really at the forefront of the profit taking. The Philadelphia Semiconductor Index today down 5.7%, gave back all of yesterday's gains. We had stocks like Lumentum, LITE is the symbol, down $81.88, 8.55% loss to $875.36. Monolithic Power down $155.77, 9.43% loss to $1,496.52. NVIDIA gave money back, $5.03 loss there, down 2.37% to $207.42. The list just goes on and on. Not saying anything fundamentally changed, not like you had a bunch of analyst downgrades. There was really no news behind it. This is, again, I had a discussion with a client about this yesterday. You got to be careful with the semiconductors, man. They can make you a lot of money when they have the momentum on the upside, but they can lose you a lot of money really fast, like you experienced today, when they have the downside. So you have to use them as part of a diversified portfolio, not put all of your eggs into semiconductors. Even though it
John, can
makes
I ask
sense.
you a quick question? Sorry to
Sure.
interrupt. Yeah.
Yeah, no, go right ahead.
Do you, I mean, I hear you. Again, I'm being layman on this because I hear you. Does this have a potential to be a .com type of, or is it just too widespread?
I ask myself, Dwight, I ask myself that question literally every single day. Is this a .com? It has so many similarities to it. The difference versus the .com really comes down to the number one driver behind a stock price, which is earnings, right? We had no earnings for the most part in the .com era, right? Companies were just coming public. They'd only been around for a year. They're being, their CEO's a 19, 21-year-old kid that still has pimples on his face. That side of it is different, Dwight. These companies, for the most part, are making money. What I think is going to happen, it's not going to be a .com bubble burst, but what I don't like seeing, underneath the surface right now is we are seeing the likes of, well, use the most recent, NVIDIA yesterday, going to the bond market, borrowing $25 billion, right? We've seen them. We had Meta announce that a few weeks ago. Who else? Google started the whole thing. So this has got a lot of analysts kind of looking, going, okay, we know this is a money-making area, meaning the world of AI, data centers, et cetera. But these companies are starting to either they're being very financially prudent, meaning take the risk with someone else's money, i.e. the bondholders, or they really are starting to feel the pinch that is starting to impact free cash flow, and therefore they want to cushion the bank account and bring in some proceeds from a debt offering, i.e. a bond offering. If that accelerates, Dwight, then yes, it's going to be very similar to the .com. I mean, we're at what's the word? We're at high levels.
Yeah.
Where I'm trying to get to the strata level on many of the evaluations of some of these stocks. So again, you can see these, you can use these as an excuse to take profit like today for no reason whatsoever. What you got to be careful about is when a day like today, and we've had numerous of them recently, turns into 2 days, turns into 3, turns into 5. And then like what we experienced, like I said, early last week, things got so cheap that you have to step in and buy them. When you reach that point where you don't have to buy them anymore because maybe there's other areas of the market doing well, or you've kind of closed the books for the year and you go, hey, you know what? I made a bunch of money in AI. I made a bunch of money in semiconductors. I'm going to kind of walk away, which is what a lot of institutions will do. Then the selling pressure continues and we go from there. Not saying we're anywhere near that at this point, but that's really what can happen. So some similarities, but for the most part, completely different than the .com era, simply because they're making money.
It kind of reminds me of the housing, right? When we had a bunch of subprime, we didn't qualify people. Now, even though you do have some late pays and even some foreclosures, everybody had to qualify now. So you're going to get a little bit of, the delinquencies and the foreclosures, but not nearly what you got. So that's kind of the same thing, right? That's
It's just kind of scratching the surface from a negative standpoint. No, great analogy. Great question. All right. When we come back, we'll hit the commodities, the bond market, the mortgage rates, and then we're going to delve right into our topic again, the myths of the mortgage world with Dwight Millard of OnQ Home Loans. Welcome back to the John Sanchez Show on Newstalk 780 KOH with my dear buddy, Mr. Dwight Millard of OnQ Home Loans. Again, Corey is tied up in a meeting. Once again, a record-setting session for the Dow Jones Industrial Average. We finished up 329 points on the Dow, 51,000. We're going to go 52. We're right there, 52,000 closing level. NASDAQ down 308, 1.15% loss, and the S&P lower by 43 points or 0.57%. All right, Mr. Millard, let's talk a little bit on the mortgage side of things. And how we did. Oil was good today, $4.48 loss, 76.06. You believe that? $76 now.
I know.
Gold
right?
at $4.80, 4,356. So let's turn things over to the bond market side.
I would have thought, John, you would have saw a little more movement today. According to Mortgage News Daily, you only got a 2 basis point decrease in the 30-year from 6.56 to 6.54. So I mean, the word, I guess, John, is stubborn. You
like we said,
you like the Teflon market. This has been stubbornly high.
Yes.
When you look at the mortgage-backed security market. Again, remember we moved up to the 5.5 range. It was up, the 5% was up 22 basis points. I mean, it was a good day in the mortgage-backed securities, but it's not transferring. And now I think you're going to get some comments out of the feds, right? Aren't we due?
We got a Fed interest rate decision tomorrow.
Well, and we don't expect anything, right?
No.
Do you think the commentary is going to be different?
Oh, it's going to be different. I mean, this is the first meeting led by Kevin Warsh, our new Federal Reserve.
Is this going to be good or bad? Is he going to put his foot in his mouth or what? I mean, does he realize everybody's going to
have no idea.
Dissect every comma and period? And
I don't know the man well. That's one thing with these chairmen. They sit in that position for quite some time, and you get to learn their mannerisms and fairly predictable of what they're going to say and do. But somebody like this, he's been around a long time, very well respected by the street. But I don't know, Dwight. There's no one on the street saying he's going to do anything, to the rates tomorrow. But again, as you said, it'll all be about the commentary and what he has to say about the potential, because the street right now is still banking on the fact that we're going to see the first move is going to be an interest rate increase, not a decrease. Now things are changing now, and you can't tell me that this didn't have anything to do with the president urging Iran, which in my opinion, I'm going to probably talk about this a little bit tomorrow when I do my estate planning topic, but my gosh, I can't believe the things that he is handing over to Iran. It's like, why did we go through all this? Why did you put the world in, I don't care about the world. I care about us. Why did you put us through this? He's releasing hundreds of billions of dollars and giving them oil. And I mean, on and on and on. So, bottom line again, as I said, $4.48 loss on oil today. Get off my soapbox. So we got a nice loss there, which we know the importance, as we've done many shows on, about oil impacting inflation and so on and so forth. So I think, Dwight, I think Kevin Warsh is probably going to play it very close to the vest. He's going to say, yeah, okay, oil prices are down. We should see some relief in inflationary numbers going forward, but way too soon to tell. And, come back in another month or two.
And that would be a safe play, right? Just, hey, things are changing.
He's not going to upset anybody with that. That's what the street's expecting at this point.
So I think, John, with that said, I think we're going to see probably the 30-year fixed, at least for the next, probably throughout the summer, right? Be in that stubbornly 6.5, maybe 6.34 range, which doesn't give anybody much relief.
No, not one bit. Not one bit. Yeah. And we were a 4 basis point decline on the 10-year today, 2 yield of 4.43. I forgot to mention that side of it.
And that's still 4.43. Still, that's a long ways out to get inside that 4. I mean, it really is. That's months.
Yes. That's months. That's right. Okay, my friend, let's get down to your topic, which again are a lot of issues going through people's minds right now. And we're calling them myths, right? So Dwight's put together a great list of mortgage myths that potentially could be costing home buyers thousands of dollars. Well, hopefully not you guys, not our dear beloved listeners. Dwight, we're going to start with the first one. We touched on this briefly. Let's start with myth number 1. You need a 20% down payment to buy a home these days.
Absolutely no. That's factually incorrect, John. I actually encourage people to look and weigh the benefit and option of putting less down. Again, conventional, you can get away with
rationale. Let's break down. What's the
rationale? You're not getting enough ground for tying up the money. You're just not gaining enough. I mean, they can take that money, John, and go put it with you and make, they're not gaining enough ground with it to tie up all the capital. And then what you find, John, is people get in and they put that money down. Then guess what? I need a new couch. Guess what they start using? Their credit cards. Yep. They start using credit cards. So
this is a great time for you to give one of your excellent reminders about the correlation of roughly $10,000 and what it really does as far as $10,000 as far as the down payment and the minimal impact it has on the payment amount. Let's go through that.
I mean, John, you're looking at about $50, $55
$10,000
for every 10,000. Right. And then all of a sudden you get into the house, something goes out that you didn't have under warranty or something, and you go charge a credit card at 18, 23, whatever percentage. So I just am where it really becomes super effective, John, is if you have high credit scores. So if you're in the 750 plus range and you're doing typically a 5% down conventional, you will find that the mortgage insurance, now we have really aggressive tiers with all these mortgage insurance companies. The mortgage insurance is almost next to nothing with great high credit scores and 5% down. And you have the ability to remove it, self-initiate removal of the mortgage insurance down the line. So it just doesn't make sense to tie up all the cash.
I completely agree. And that's the beauty of real estate, right? Over the stock market, over other things, it's the leverage value of the dollar, right? That's the beauty of it. But here's a little exercise I always like to tell people, Dwight. So let's use your $10,000 down payment. Let's make it really simple. All right. So you put it down, you save $50 a month. 50 times 12 months, that's $600 a year. So you're making 0.6% essentially on your money, right? Can you beat that 0.6% if you invested that money? Probably so, even in a very safe, savings account, right? So, we not 0.6%. So that's what you have to look at, right? That's how the big money does it. They go, what's my return on investment with going into this, paying down debt, or putting it as a down payment versus investing it. And I don't care if you're invested in a more real estate or, to me, Dwight, I think, and I haven't ran the numbers, so correct me if I'm wrong, but let's say you didn't put that 10,000 down, right? You saved that and you invested it. And then in maybe, 5 years, hopefully you've got some good growth out of it in the stock market. And then you take that and do a principal reduction, right?
Correct. You can always, I mean, most investors agencies allow for a minimum of one principal reduction, and you can even recast if you want, if it's significant enough, meaning a principal reduction where you can reset your payment. But John, I've never broke it down like that, but you're absolutely correct. I mean, if you can't make more than 0.6 somewhere, and again, you got to be a little disciplined. You got, what I'm saying, but but I just have never really seen the benefit. Now, if you have a lower credit scores, then I mean, now you're looking at FHA. You're looking at some different other
Mm-hmm.
products that may, but still tying up FHA. There's no sense in going to an FHA putting 50% down at all.
Right. Right.
You put
Yeah.
3.5, maybe 5% on an FHA is the max you'd probably want to go.
Right. Right.
Yeah.
Exactly. All right. There's myth number one. Do you need 20% down payment to buy a home? The answer is absolutely no. Now, to Dwight, what Dwight just mentioned a second ago, a lot of this depends upon your credit score. So, next myth that we're going to demystify when we come back is, do you need perfect credit to get a mortgage today? Welcome back to the John Sanchez Show on News Talk 780 KOH with Dwight Millard of On Q Home Loans. Again, Corey's tied up in a meeting, and it was a record-setting session. If you just joined us, with the Dow Jones Industrial Average for the first time ever in history, hitting 52,000, up 328 points on the day. NASDAQ sloppy. Again, semiconductors rolled over, lost 308, and the S&P down to 43. All right, you're up to date on the market as we spent a lot of time talking about that. We're just beginning our topic today, which again is a very important topic, which is breaking the myths of the mortgage world, the mortgage process. Dwight did a great job on the myth number one, which is you need 20% down payment to buy a home. Absolutely not true. So he discussed that. Myth number two, Dwight, you need perfect credit to get a mortgage.
Absolutely, absolutely not. Another myth, right, John? Here's the cool thing about today's environment is even if you don't have great credit scores, let's say you have mid 500s, even just say we have programs now, probably artificial intelligence, right? You like the AI,
I'm sure,
that will tell you what you need to do because it's analyzed your credit report to start moving up your score. So it's never been easier to move your credit scores up. If you have the will and the desire
and
and
you've
the
offered
means.
this for 20 years.
Yeah.
And
We
now
call
I
it a
bet it's even
rapid
better today.
rescore, but now
Yep.
AI's gotten even stronger, better, bigger, faster to help you identify the weak areas and get stronger in it. So I would tell you that right now, I think I would like to see at least over 600, and which is not,
Yep.
there's a lot of programs out there that kind of go off of 600, 620, even your first time home buyer. There's just different things, but typically on an FHA loan, if you get above a 600, you can typically get an automated approval if all your other variables are good. So if all your variables are bad, your credit score, you don't have any down payment, you've been on your job a year, things like that, it may be. But if your only downside to your complete application is your credit score, if you get over 600, I think I can get an FHA approved. So I would just tell you that that's what that's what I'd shoot for, is that, get above 6 and then higher.
Above 6 and higher. Exactly. And for those that may be new, I mean, you and I obviously, and most of our audience knows this, but I'm sure there's a few out there. Why does the credit score have such an impact, Dwight?
Well, because now everything's risk-based pricing. Ever since the great meltdown of 08, 09, coming out of the Dodd-Frank, everything has an add-on. So it all ties into your loan to value and your credit score. So credit scores dictate not only what your rate's going to be, it's going to dictate what products you have available. Not only that, as you go into this, you're going to see that your homeowner's insurance they're going to run your credit score. I mean, there are so many variables throughout the home buying process. Your credit score is going to become very important. The one thing that I do like about a mortgage loan, a good paid up mortgage loan, affects your credit scores really, really good. So, if somebody has a weak credit score, like let's just say 620, and we get them into an FHA loan and 6 or 8 months from now, good payment history with that mortgage, you'd be surprised what their credit score would be. So it's
no kidding.
Yeah.
No kidding.
Yeah. It's a great that. And that's the best, actually.
And as a reminder, things like your homeowner's insurance, also a lot of the factors based on credit score and so on and so forth.
There are so many things that base it. And it's just to your point, your original point, you're wasting thousands of dollars all the way around. If your credit score is in the 600, 605, 610, you can get that up to 680, even greater. You're going to save a lot of money.
And just real quickly, because this is a whole nother show, what's some of the fast ways for people to improve their credit?
Pay down anything that's outstanding balance, pay it down or pay it off. I would run a credit score if you can. Go to those. There's free ones to get an idea. But I mean, the best way is to just try to chew at the balances. Any collection accounts, anything that's derogatory, just get it current. I mean, there's still a lot of student loan, John. Still a lot of student loans out there. Remember, they thought it was forgiven, and now it's. Once you get that current, it starts the healing process. So just anything that is outstanding right now, just and just pay. Yeah.
Okay. And again, I love your idea. And for those of you that may be new to the show, just a reminder, Dwight has always been generous enough over the years to offer this, and I'm sure he'll do it again. If you need to know where you are let Dwight know they can run the credit. It's a soft pull. It's not going to show as a credit pull, etc. And then the software, basically now AI, will come back and say, you need to pay down that $3,000 Discover card. And you need to pay it down to $1,220. You'd be amazed at the crazy things, but that's the power of that software. And then if you're not ready yet, great. Now, like you said, I love your words. You started the healing process, right? You set your sights at maybe 6 months or a year, you'd be ready.
It's just John, and it's a pre-application process. Doesn't call you if you don't, it doesn't cost you anything if you don't close, but we get you prepared. We get you in the motion. And to your point, we had one, I think I told you once before that I was trying to do a rapid rescore and it actually said, go out and get an account, and go charge.
There you go.
So it's not always pay down. It's like you need a little more credit. So
Yep, absolutely. All right. I don't want to beat this one up because we talk about it all the time. Should you wait for rates or why should you wait for rates to come down? And that's not necessarily the case at all. So real quickly.
Yeah. I mean, we always say you marry the house and date the rate. So, I mean, you're going to have opportunities throughout your tenure with your loan to probably redo it a couple times, even if you've been in it. Right. So I would focus more on what the home, is it what you want? And is it, can you afford it? Like Corey always talks about.
And is it good value?
You're
not overpaying, that type of thing.
Everything else will fall into place.
Absolutely. Myth number 4, a 15-year mortgage is always better than a 30-year mortgage.
I'm going to give you my opinion. I like it. I don't think you,
folks, if you could see
yeah. I don't think you got a big enough spread today to justify taking down a 15 versus a 30. What I like is paying the extra. I can always calculate what your 15-year payment would be, take a 30-year mortgage and pay a 15-year payment.
There you go.
Have the flexibility on your own, because come Christmas time or your transmission goes out or whatever, you're not locked into that 15-year payment, but you have flexibility. So there's no accelerated penalty on these loans. So you can pay more. And John, the other thing too is do not buy into one of those bi-monthly payment deals. Yeah, because they're so hard to unwind. They charge you to do the same thing you can do on your own. Yep. Very hard to unwind.
And just to give you a comparison, according to Mortgage News Daily, as of today, 15-year mortgage is at 6.11% nationally. And as Dwight said earlier, the 30 years at 6.54. So not a significant difference there.
Yeah.
But boy, talk about higher payments.
Yeah.
I love your idea. And we always recommend that to clients. If you can afford it, if you got the cash flow, turn your 30 into a 15, you have that flexibility and you can always do more. I mean, it is amazing. It's a lot of fun if you're a numbers nut like I am or geek. Get an amortization schedule. There's all kinds of online sites like that and just play around and watch and see how that 30-year mortgage, how you can bring it down to 18, 19 years just by making a few $1,000 principal payment reduction each and every year. It's mind-boggling because of the compounding effect. With that point, Dwight, here's something you need to let everybody know. Quickly explain how simple interest on a mortgage loan works, because a lot of people have no idea that it's front-loaded versus the back end.
And it's just it's calculated on your balance. So the lower your balance. And so John, to your point, I like the 2,000, but spread it over 12 months, get that, unless you have the 2,000, you can do it often, but so each month in theory, your interest calculation goes down a little bit of dollars than what it did because your balance is less. So the more you can attack that balance up front,
and it's daily,
and
it's daily, right?
Yes.
Because mortgages,
the more you can attack that interest up front, the better off you are. So if you have the discipline now and may not have it later, do it now, because that will make a bigger difference than down the line.
And folks, I can tell you from a financial planning standpoint, looking back at thousands and thousands and thousands of clients I've had over the years and that I currently have, one of the key ingredients, there's 2 key ingredients to financial success. Well, 3. Start early. Number 2, live on a budget. And number 3, get out of debt. And I'm throwing them more. So if you have aggressive ideas where you want to retire relatively early, I'm talking early 60s, something like that, way beyond normal retirement age, get the house paid for. I know it's not the best use, but let me tell you, you have that stress relief that you're not having to make that $2,000, $3,000, $4,000 mortgage payment. So again, if you plan your retirement, say 15 years in advance, great. Meet with Dwight, meet with your mortgage company and go, hey, I want to pay this thing off in 15 years. Mortgage companies love this. I want to pay off my mortgage in 15 years. What do I need to do? They'll come back and they'll play with the amortization table and come back and go, oh, okay, Dwight, you need to pay an extra $300 a month. And now you cut your 30 into a 15. It's literally that simple. But you're talking hundreds and hundreds of thousands of dollars of interest savings doing that.
And John, to your point, you could do it any time in the game. So if your kids are out
Anytime.
of college
Anytime.
now and all that,
That's right.
it's not too late to start right now. You couldn't do it when they were
Nope.
in college or whatever's going on.
Yep.
Do it when you can. And you know what, John, if you can't, just pay whatever. I think the minimum is $35 or $50 per month to go to
Yeah.
principal.
Yeah. I was going to
Start
say about
there.
30 bucks.
Start there.
Yeah, that's right.
Start
It
there.
all adds, it's like
Yeah.
your 401k. Start with
Yep.
something. That's
Yep.
right. Yeah. Welcome back to the John Sanchez Show on Newstalk 780 KOH. Mr. Millard, your phone number, sir.
Yes, sir. 240-2022.
Very good. Thank you. All right. We've been talking about myths in the mortgage world. Yeah. So many that are heard. And again, we could go on and on. Dwight again put together a great 7-point list, but multiply that times 1,000. You probably still have more. All right, Dwight. So we talked about the 15-year myth number 4. Let's go to number 5. The lowest rate is always the best loan.
Well, you think so, John. But here's the problem. You always trade off cost for rate. So meaning that, during the refinance crazes, you hear companies advertise no cost refis. Well, all they did was trade off the rate to give you the cost. So you always will have that as an option. What you really want is the middle ground. You want to get the most attractive interest rate you can and maybe minimize some costs. So if you can find the sweet spot in there, and that's where your loan counselor should come in and kind of give you that idea. Hey, if you go up just an eighth in the rate, and again, the spreads are different every day, John. So if you go up just an eighth in the rate, I can give you maybe a $1,500 credit, type of thing. So they just have to really, it's just not that easy. A more sophisticated or longer person in the business will have more information on that. But yeah, it's not always the best.
Well, yet again, we probably did an entire show on how a APR is calculated, because a lot of times that's where they'll get you too. You need to pay attention to the APR, which is your loan interest rate plus all the other junk thrown in.
Yeah,
Is the term,
yeah.
right? And so that's really what you got to look at. You got to look at points. You got to look at the closing costs, the structures we discussed, 15, 30. Look at everything versus the advertised rate.
And
right?
and John, I
that is
think,
the bottom line.
yeah, and I think most people that pay over a point, now if the seller pays, it's a different thing. But you as the consumer, if you pay over a point, I'm going to guarantee you most of the time you're not going to recapture your benefit.
Amazing.
It's going to take you too long.
For those new, explain that.
Yeah, so let's say you're going to pay 1.5 to buy your rate down. Let's just say, I don't even know if you can get a half a rate today, but let's just say you're going to pay 1.5. Yeah, 1.5, you're going to get a half better in rate. The savings that you're going to get is going to take about, maybe in that particular case, let's just say 5 years to break even. So it's going to take you 5 years before you even feel the benefit of buying the rate down. Well, if rates drop or something happens or you move, that's why I say most people don't take advantage of the rate buy down. They don't get there. They don't get the longevity out of it.
And remember, I was hoping you were going to say, a point is, remember, there's a 1 point is 1%. So again, when you're saying 1.5, Dwight, if it's a $100,000 loan, 1.5 points, that'd be a $1,500 that you're paying. That's
right. And you get up to the $500,000 range, John, you're paying $7,500 for 1.5. And again, if you don't even feel the benefit, of the buy down, which is just the savings divided by the cost, if you don't even for 60 months, I don't know if it's worth it.
Well, what happens a lot too, Dwight, is, we know that a mortgage is an ego-driven thing for a lot of people. They want to be at that barbecue on 4th of July and go, hey, I've got a 5.5% mortgage, versus, what do you have? 6? Oh, you poor sucker. But again, you don't know that the buy down did that, and it did not make financial sense. So don't try to keep up with the Joneses, keeping up with their mortgage rate versus yours, because there's a lot of factors: timing, how much money down, buy down, credit. I mean, a number of different things. So
John, I found many times it was a temporary buy down, not a fixed rate, when they said, oh, so-and-so got X. X didn't exist. Right. Yeah, X didn't exist.
Absolutely. All right, Dwight, I'm going to handle myth number 6, kind of coming down my bailiwick. Renting is always throwing money away. That is not the case. I've had many situations over my career where I've recommended to a client the best thing to do was to rent, right? Especially if they're in their retirement or years into their retirement. They don't want the time. They don't have the physical capabilities, so on and so forth. They can afford it. They don't want to go hire gardeners and mess with home maintenance and everything else. So go rent somewhere. Let somebody else have the headache, right? So don't always think that renting is just throwing your money away. Younger people, yeah, most likely, but get up in age, it's quality of life is the way I look at it. And wrap us up on number 7, Dwight. Getting pre-qualified and pre-approved are the same thing.
Yeah, no, you really want to get pre-approved these days. I mean, you're actually getting it ran through an automated system, all the variables in there, and it's ran through a system. And John, knowledge is power, right? So, to your point, this is what this show's all about. Know what you have in front of you. Know your facts.
Yeah, absolutely. All right, my friend. Excellent job as always. We'll have to continue this one on because we just barely scratched the list. Dwight Millard on Q Home Loans. Thank you, my friend. Always a blessing to be with you. God bless everybody. We'll see you tomorrow on the John Sanchez Show.